Alright guys, so the situation is getting from bad to worse. When Trump started his trade war, it was based on a few fundamental promises. He told people that the world will capitulate, but big economies are fighting back. He wanted bond yields to drop, but yet they are shooting up. In just 7 days, we have gone from under 4% to over 4.4%. That's an incredible rise that signals a big repudiation of US Treasury demand. In fact, yields have gone past 4.5% over the last 24 hours and might hit even higher. This was not supposed to happen. It's not in the playbook. In times of chaos, the default plan is for everyone to run to US assets, and the ultimate safe haven was the Treasury bond. But yet, the world is dumping everything. It gets worse when we realize the plan was to engineer a recession to lower bond yields. The US has a ton of debt that's coming up for refinancing, and now interest on the national burden is going to be unsustainable. And let's not forget, in 2025, Besson will have to refinance over $9 trillion worth of US debt. He is caught in the spider's web. With the 10 years spiking to the moon, does he dare to issue long-dated treasuries? And if he does, there's a chance of the entire market walking away. Then we could see everything from mortgage loans to car notes in the real economy exploding. Flooding the short-term market with T-bills also isn't the answer. It will counter the effect of the Fed rate cuts and destroy what trust is left in the system. By imposing a global tariff, Trump is not just punishing global exports, he is also destroying the flow and demand for dollars. If global trade with the US drops by 10%, the demand for dollars would also drop by that amount or more. The situation is so bad that even Janet Yellen is back, scolding Scott Bessent for blowing up the economy.
How the Trump administration has handled the economy thus far?
I'm afraid I could not give it a passing grade. I think policy has been, this is the worst self-inflicted wound that I have ever seen an administration impose on a well-functioning economy. This is going to be devastating for American households and workers.
The likelihood of a recession due to President Trump's economic policies, in your view?
Well, it's clearly risen.
Now you know you have screwed up when even Yellen, the architect of the previous mess, looks like a hero. Yeah, she oversaw enormous deficit spending in the Biden White House, but the time bomb did go off under Bessent and Trump. The problem facing the US today is even more enormous than just 3 months back. Trump is trying to reshore industry while cutting China completely away while the world is boycotting US goods. The last thing he needs is the US dollar collapsing, but that's exactly what is happening today. The US dollar index has crashed below 100 points. This is a big level that will just fuel even more bearish bets. Here's the problem with a plunge with the dollar. Around 15% of total US consumption comes from imports. The US doesn't have an industrial base yet, so a weakening dollar isn't a net benefit. People will be forced to spend more to buy less. It's not a good situation when prices in the US will rise by at least 10% in the country. This sandwiches Trump in a very bad situation, especially with his 90-day pause. If he U-turns the reprieve and turns up the heat, we could see a serious consumer collapse that will freak everyone out. However, a study in Yale just found that Trump's pause does very little to the overall tariff rate. We are still in the danger zone and the overall damage to the economy has been done. If the prospect of the US economy is bleak, and if we are going to enter a recession, it destroys investment demand. US markets are propped up by a lot of foreign money, and they are leaving for a reason. It's not some big conspiracy theory. Investors go where they are treated the best. According to Yale, the effective US tariff rate has gone from under 3% to at least 18%. And that's if US households can substitute certain products for cheaper alternatives. But if the consumer can't, the real tariff rate is nearly 25%. To most people, that simply registers as higher inflation. That's a big sticker shock. Now, I don't know about you, but if prices suddenly rise by 25%, my first reaction would be to cut back spending. I will stop buying beef and switch to chicken. And if it gets worse, I'll eat at home and stop dining out. It really isn't that complex. Tariff raise prices and people across the board, across the US, they consume less. There's a reason why so many companies are refusing to give forward guidance on their earnings. It's because they have no idea how bad the devastation will be. The Yale study quantified the economic impacts and it's not looking good either. US real GDP will fall by over 1% this year alone, which is actually a really conservative estimate. Unemployment will rise by around 0.6% and payrolls will be 740,000 lower. Fewer jobs will be created, but the hit will last for a very long time. Even until 2035, GDP will be persistently 0.6% smaller. This is the fundamental reason why money is leaving the United States. We have no idea how bad things will get and how much of a point Trump wants to prove. Investment money hates uncertainty, and the last 7 days really did a number to everyone's confidence. But let's talk about the main event. The US China trade war is also injecting a ton of uncertainty. Trump refuses to back down and hike the tariffs to over 140%. China has also vowed to fight to the bitter end. They have called US tariffs a joke and they aren't taking it seriously anymore. And whether you like China or not, this statement confirms the end of US China trade as we know it. Given that US exports to China are already commercially unviable at current tariff levels, any further US tariff hikes on Chinese goods will simply be ignored. Beijing has now raised the import tax on US goods from 84% to 125%, and honestly, given how expensive American exports are, this is already excessive. No further response is needed. It's critical to understand what investors are seeing today. Trade flows affects the viability of investing in the US markets going forward. Investment dollars don't discriminate. The US markets have been priced at a premium for decades, and if the narrative of the US being exceptional collapses, we could see bigger downsides ahead. And no, the 90-day pause isn't enough to U-turn things. And I'll explain this simply. When the US raised their tariff rate to 145%, this means US consumers have to pay more. Half of Walmart is stocked with Chinese goods, and replacing those items will cause prices to rise. So people will either buy the more expensive alternative or just cut back spending altogether. Their budgets get cut and US company earnings they take a big hit. When Beijing raised their tariff to 125%, this effectively blocked out all US exports into China. That's around $150 billion worth of revenue vanishing into thin air. American companies take another hit, and the longer this goes on, they will have to reroute their exports to other countries. But the trade war has created quite a pickle here. Other countries like Canada have imposed a 25% tariff on US goods, so selling elsewhere is also problematic. US companies would either eat some of the tariffs or their overall revenues would fall. And as we pointed out before, neither Trump or China can cave. His voter base will lose their minds if Trump U-turns first. Meanwhile, Beijing will also dig in because they believe they can outlast the US. Here's how confident the Chinese economy is, and people must take this very seriously.
China is fully prepared to fight to the very end because the world is big enough that the United States is not the totality of the market in the world. So if the United States wants to go in that direction of completely shutting itself out of the China market, be my guest.
Yeah, and China will lose the US market, which, as I've said, is 15%.
We don't care. We don't care. China has been here for 5,000 years. Most of the time, there was no United States, and we survived. Right. And if the United States wants to bully China, we will deal with the situation without the United States. And we expect to survive for another 5,000 years.
Now, as a third-party observer, the message is clear. China is not going to yield and neither will Trump, at least not for a while, maybe even years, which means the US economy will be facing big headwinds to grow. Investors, they just don't want to hear that. The dollar sell-off tells us all that we need to know. More currency is being sold off than what is being bought, and that isn't good for US assets going forward. Confidence is being lost. And here's why foreign money is important for the US, and I'm sure Besson understands this. Foreign investors hold around $7 trillion in US bonds, $19 trillion in stocks, and $5 trillion in corporate debt, and that accounts for up to 30% of the entire investable US market. And everything is selling off today. Stocks are down by at least 10%. The dollar index is down by over 5%, while bonds have plunged by 8%. And if they keep getting spooked by the tariff war, we could see further downsides to come. This is just from foreign investment dollars. We haven't even talked about domestic US investors yet. At the end of the day, people want stability, uncertainty destroys trust, and money will leave an economy that shows that. And as mentioned before, the weak spot of the US economy is the Treasury market. That is the gold standard of safe havens, and people buy it for a reason. It's supposed to be a boring investment where two things just don't change. You want the value of the dollar to be stable. If it keeps dropping as a foreign investor, you lose money when converting it back to your local currency. Secondly, investors don't want to see this happening in the value of treasuries. Long-term bonds are seeing the biggest rise in volatility since last November. Both the 10-year and the 30-year yield are jumping around like drunk people on the disco floor. We can see big moves of up to 8%, which is insane. If bond values keep swinging up and down, many investors will just choose to sit on the sidelines and do nothing. In fact, a certain portion of them will start to dump their holdings, and whether it's for margin calls or weak stomach, it really doesn't matter. It drives yields higher. According to JP Morgan, the effects are very real. Every 300 billion decline in foreign holdings of US bonds would push the 5-year yield higher by 33 basis points. There's a lot of speculation that China has dumped their bonds. Maybe they did, or maybe they didn't. We won't know until a month or two when they update their holdings. But it pays to remember that China is just one country. Many other nations, especially the G7, they hold a ton of US bonds. We need to zoom out and look at things holistically. This is a chart of the G7 allies, their treasury holdings, and the tariffs they are facing if Trump U-turns again. Japan holds $1 trillion of US bonds and they face a 24% tariff. The UK, 740 billion in US debt, facing a 10% tariff. For Canada and France, both have over 300 billion and they face at least 20% in tariffs. Do you see where I'm going with this? If trade between the US and the G7 slows down, their incentive to buy treasury bonds will also drop. Why hold US treasuries when I face steep trade barriers? Now you multiply this to the rest of the world, including China, and you can see how systemic this problem really is. Hopefully the Trump team understands this. You can't possibly reverse decades of excessive spending and reshore industries in a few months or even in 4 years. This is going to take a very long time, and trying to speedrun this will only yield disastrous results. But let me know what you think. Will the dollar fall further or rebound? And will the US be forced to abandon their tariff regime? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.